Hello everyone, my name is Mark Seaden. I'm an Employment Tax Director at BDO working in the Thames Valley. I'm joined today by my colleague Steve Hiron, also a manager in the Employment Taxes area. We'd like to talk with you today about three areas that we're speaking to clients about, namely working from home, a common practice for many employees up and down the country, around the coronavirus job retention scheme, and unfortunately around termination payments and the taxation of those. So just thinking about it, Steve, a year ago, working from home was something that was done on occasion, but certainly not to any great extent. Whereas now we're in a situation where large parts of the country is working from home. I think even once coronavirus is over, we're still going to have people working from home to some extent. I think it'd be useful just to have a chat about what we're seeing around the use of equipment and technology, around the use of allowances, and the impacts around travel and subsistence, what people are talking about on there. There's obviously also the international aspect, and there was a great webinar that was done on the 3rd of February. I'd recommend people have a look at that to look at some of the legal matters as well as the tax matters, because that comes in. So Steve, what are you seeing around people working from home?
Thanks, Mark. As you mentioned, employees may be required to work from home, under the rules of the pandemic. What we're seeing is typically employees either work from home by choice or there's a requirement to work at home. So, and the rules can change depending on that outcome. However, there has been some special measures put in place for the current tax year. So, for instance, around equipment, the purchase of equipment for, use to work, really. So there's a temporary tax and national insurance exemption where the purchase of home office equipment as a result of working at home and reimbursed by the employer is tax exempt. So that's a good source of expense an employee can claim. Obviously, it is provided that certain conditions are met. For instance, the equipment has to be, for work, and it would have normally been tax deductible, if it was provided by the employer anyway. We're also seeing lots of questions around additional household expenses, broadband costs, additional heat and light. Obviously, we're all working here now. So just taking broadband, for example, if the broadband connectivity connection is needed for work and you didn't have one before, then potentially there's you can claim tax relief on that. However, if you already had broadband at home, then unfortunately no claim can be made. As an alternative, there is a tax allowance, a home working tax allowance of £6 a week from 6th of April 2020. This is really for sort of additional household expenses, and the government have relaxed the rules around this for the 2021 tax year. So this is worth claiming. And I guess the other area is around travel and subsistence. Obviously, now we're all working at home. What's our workplace? Is it at home? Is it the normal office?
Yeah, it's an interesting area because there is no new legislation around travel and subsistence. There's no guidance that's come out from the revenue around travel and subsistence. So all we've got there are the old rules that you need to look at, and everything there is based on, is the location I'm going to a permanent workplace or a temporary workplace? And there's various rules as to how you arrive at a conclusion on that. And what clients are asking me is, well, if this person has spent so little time in the office, if they come into the office next month for a day, is that now a temporary workplace? I think it's a very tricky area. I think it's something that you change only after giving it a heck of a lot of consideration. I think if I started going to the office now, it would still be my permanent workplace. My contract says it is. If you look back over the last 2 years, I've spent a fair bit of time there. However, in another case, if you've got a client that has perhaps closed an office off altogether now, so the office that was their permanent workplace is gone, then I think there's more of an argument to start looking at that and saying, is if they now go into a new office, is that a temporary workplace? So there is a lot to do there, but you need to take care when deciding which route you're going to take. I think you need to look at the contractual position and perhaps get some employment law advice as well, and also the day-to-day working practices. So quite complicated, as you say. So yeah, in summary, I'd say that overall, there's a lot of complexities around working from home. You need to make sure you've got good procedures about making sure you know where you've got your equipment, who's got what, so that if need be, you can recover it. If you need to report anything to the revenue, you can do so. Allowances are useful, but again, making sure that you don't double up so that the employee is claiming the tax relief and you're paying it. So just watch out there. And then finally, travel and subsistence, incredibly complicated. Do get advice and do look at what you should be doing before you go ahead and do it. And just very quickly again, do get legal advice on people working from home as well. Another area that we're seeing a lot of employee questions around is the Coronavirus Job Retention Scheme, or CJRS. It's a very new area in the UK, and go back to last March, I'd never used the word furlough, but it's certainly become part of my standard vocabulary. It's certainly a big area of government support that has probably protected a whole range of jobs up and down the country, in certain sectors particularly. But it is complicated, and I thought it would be worth talking with you around some of the complexities within the CJRS, what we're seeing from HMRC in the terms of activity and reviews, and some of the errors that we're seeing when we're talking to clients. Looking at some of the complexities, one common error that I'm seeing with clients, and it's one actually that the revenue can find quite easily, is around the eligibility criteria, which are such that an employee had to have been on the payroll effectively at the end of February, on that RTI submission at the end of February. And that's obviously for the first wave of CJRS up until the changes for November. Now, if an employee wasn't on the payroll, if they hadn't been included in an RTI submission, then you can't claim for that employee in March, April, May, June, etc. That they would not be eligible for the grant. I've seen two areas linked into this. One where employees are 2P'd in, and that's helpful because if an employee was 2P'd into a business, you can still claim. So somebody who was employed elsewhere, then 2P'd in from March, they would still be eligible employees. So that's fine. But there's other areas where, for example, an employer might have made a job offer which had been accepted, and that was done in February, but the employee came onto the books on, say, the 1st of March. Because that employee was not an employee on an RTI submission at the end of February, they are not eligible for the grant and therefore shouldn't be included in any claims made. So really difficult areas, and as I say, really easy for the revenue to find because they know who was on RTI at the end of February and they know who you're claiming for at the moment. Steve, I understand that you've had some discussions as well around turnaround time for these claims. Did you want to talk about that?
Yeah, sure. Yeah, just going back to your point, you know, the rules have changed so much as well. You know, we're getting every month almost a new set of rules, so it's quite hard to keep on top of. You know, and you've got fixed, variable paid employees, flexi furloughed employees, businesses starting and stopping really. You know, when the government measures are put in place, so there's quite a lot to take on, and then so. Up until October, the claims were quite flexible. You could get them in, but from November, you've now got this 14-day period after the end of the month in which the claim you're making. It's quite strict. You know, you've got a lot to get done in a small amount of time, and you know there are some extreme circumstances where you potentially you know, if you don't submit it on time. But you know, it's sort of things like, unless you've you know, got COVID yourself or anything like that, it's quite, you know, it's quite difficult to get to get around that. There is a short period of time after the 14 days, so you get another sort of couple of weeks to make any amendments to what you've put in. But still, it's quite a quick turnaround. And like I said, it just gives you very little time to audit yourself, and the errors, you know, just could be so easily made. I guess what we're also seeing is the revenue are now looking at claims that have been made over the last 10 months now. It's crazy. Yeah, so, and they can be quite onerous. The questions that they're asking, it's almost, you've got to prove that they're right rather than they tell you what you've got wrong. So it's quite difficult. So I guess here one of the key points that we're finding is just make sure you've got good records to support your claims, and I think you're going to have to keep them for a very long time. You know, the revenue could sort of inquire into you up to 6 years afterwards. So it's yeah, it can be quite onerous.
Very good point, Steve. Yeah, I do agree. The revenue are going to be looking at this in years to come, by which point they might not be quite as generous and flexible as they are now. So absolutely keep that documentation. As I said, it's really complex. And as you said, the rules have changed many times over the last few months. So yeah, we do need to keep the documentation. I think employers need to review the claims that they've made. That might be an internal review. It might be a case of speaking to your advisor and seeing what they've got, and perhaps doing some spot checks on your calculations, or possibly using a tool. BDO have got one, for example, that helps you do a risk assessment, but do those checks and make sure that they're fine.
I guess so. The last point that we was going to talk about was termination payments. I guess the sad truth is, despite a range of government support measures, inevitably there will be redundancies. I'm aware that BDO had a recent survey which pretty much said up and down the country there are going to be, you know, redundancies. So it's definitely on the cards and likely to be, you know, more in the coming months. So I guess what would be good to talk about is, what do employers need to think about, and, you know, around the legislation, preparation and planning for redundancies.
Yes, Steve, indeed. Yeah, legislation arguably is the easy part, because there is no new legislation. There's been nothing that's come out as regard to the pandemic around termination payments and the taxation. The only one caveat to that, I'd say, is that you can't claim the CJRS if you have put an employee under notice. So if you've started the redundancy process and you've put employees under at risk of redundancy and put them under notice, you can't then claim the grant for anybody in those circumstances. So no legislation regarding the actual taxation of the termination payment, but I think it is important just to revisit one or two areas, because termination payments do continue to catch people out. The area I'm thinking about specifically is around post-employment notice pay, or PENP as it's sometimes called. In the past, there was a lot of debate about whether a payment in lieu of notice, a pile-on, whether that was taxable, and it would depend on the contractual nature and what's in handbooks and things like that. The Revenue felt that all payments in lieu of notice should really be taxable, and therefore brought in legislation to say that on termination, in circumstances where an employee hasn't worked to their notice in full, a part of the termination payment will always be taxable. And helpfully or unhelpfully, it came up with a specific formula for working out how much that payment should be. It uses basic pay, it uses the days of unworked notice and things like that to arrive at that. But basic pay isn't necessarily what you or I might think basic pay should be. Allowances are typically excluded, although a car allowance might be included or might not be. So that's nice and helpful. Also, basic pay is the pay before any salary sacrifice. So again, you need to be careful there. So doing the payment calculation for the taxable element is complicated, and again, do get some advice. We've also obviously got the introduction now as well with Class 1A national insurance being due on the element of the payment that is over 30,000. If it is a genuine redundancy payment, and we've calculated the PENP and excluded that, we've dealt with that separately. The redundancy payment, the compensation, the ex gratia, whatever you'd like to call it, the excess over 30,000 is now liable to employer national insurance. So you need to have a think about that as well. So a complicated area. What I would advise businesses to do if they're into that situation where they're having to make redundancies is plan ahead and plan early. Speak to your advisor. Sometimes just the way you communicate something to your employees can change the tax treatment. And if we can tweak the wording to enhance tax reliefs, then that may help the employees, meaning that when perhaps you can't give them as much in the way of in compensation as you would like to do because of the pandemic, at least what you are giving them is tax efficient, so that helps employees. And similarly, you're avoiding paying too much employer national insurance yourself as well, so you're sort of helping both sides along there. And definitely think about your PENP calculation. It's complicated, it's not straightforward, so do work it through and get advice if you need to.